Hello and welcome back, my people. Firstly, before I begin, I apologize to my viewers and my community because I know you guys have been waiting for the video and I am a bit delayed because of some issues over here, work and family, and I was not able to upload the video. Neither was I able to make the video actually. So I apologize, sincerely apologize to you all. Secondly, this video is about to be, the basics of ICT concepts. So if you have not familiarized yourself with the basics of ICT's concepts, you should go back and watch the core content, snap out of it, pay attention to the boring videos which he uploads. There are tons and tons of information over there, and if it was not for ICT, none of us in the modern era would be knowing all the concepts which are available right now on the internet. So all credits to him. Thirdly, I want to welcome you all again and thank you for your appreciation of the channel and keep supporting the channel. Let us move on. Over here there is a disclaimer which says that too much knowledge can cloud your judgment, especially in the trading world, where if price reaches at a particular key level, all right, you're watching the key level since the morning, the price finally reaches the key level. Now all you're doing is waiting for your entry model. Your entry model presents itself, but then something in your mind clicks and you think that something else is also there in the concept, and your whole trade idea, you start to doubt yourself and the trade idea which you've been building since the morning. Why? Because you have all these concepts lying around in the back of your mind. It's good, knowledge is power, of course, but then where to use it and utilize it, that's the key, because it makes us impatient at the particular times. All right, so I wanted to make sure you understand that. I want to put it forward that too much of knowledge can literally cloud your judgment in executing your trades. So that being said, I want to move on to the video. First thing which I want to make sure that you have engraved in your mind, the PD array matrix. Now you would say, yeah, literally this is all basic, why are you teaching us this and that? The whole ICT concept revolves around this thing. That's why you can read, this is literally the Google definition. The PD array matrix is a hierarchy that provides a structured approach to analyzing price movements and forming directional biases based on price levels, key price levels. Whoa, that was a mouthful of information right there. Too much of word gymnastics, a lot of big words have been used in this, but that is the truth. We have to keep it like this, boring and with a lot of utility. All right, PD array matrix is a hierarchy, meaning there is a set of rules which are provided through the market, through the algorithm into the charts, which you have to look for as intricacies and approach to analyze your prices, analyze your the trade idea. How and what is it actually? How does it form and what is it? Literally, what is it? This is the premium of a price level. This is the discount of a price level. Okay. In the hierarchy of PD arrays, all right, price delivery array, premium and discount array, whatever you want to call it. If suppose price is delivering itself from a discount array towards a premium array, meaning a level, all right, the first line of resistance which price is going to face will be the mitigation block. The second would be the bearish breaker block. Because why bearish? Because price is moving from up towards the from down to the upside. All right, so second line of resistance, bearish breaker block. If this fails, the liquidity void. If this fails, the fair value gap. If this fails, it's gonna stop at bearish order block, and then if it's disrespected, the rejection block, and then finally taking out the old high. Same goes on the opposite direction. If price is delivering from a premium zone towards the discount zone, you see you've taken your entry and then price is delivering down. The first line of resistance which you will face, the price will face actually in the discount zone, is the opposite. You can see mitigation block first disrespected, bullish breaker block disrespected, liquidity void disrespected, fair value gap, disrespected, bullish order block, disrespected, rejection block, and then finally the old low, right? And this occurs in like instances, you know, on a higher time frame it will take some time, on a lower time frame it just goes on like everything is taken, and finally your stop loss is hit right there, or your TP is hit. All right, you need to make sure you memorize this thing, write it down somewhere if you already have the knowledge of this. Why I'm touching on this is, if you guys fail at some point, go back to the basic. And teaching you guys, for me, is the only way for me to, you know, implement and execute my own rules. That's the only way. So memorize this thing right there. This is the PD array matrix. All right, from one PD array, price delivers from one PD array to another PD array. All right, from old low to the old rejection block, from an old rejection block towards an old bearish block, bearish order block, from an old FVG towards another FVG, liquidity void to liquidity void, bearish breaker, bearish breaker. Oh, sorry, this was an order block. Yeah, mitigation to mitigation, or it can be vice versa as well. Sometimes the rejection block, it will on a weekly level, this rejection block on a weekly level, it will, price will react from it, move all the way up, and then take out the old high, the monthly or daily high, all right, from a weekly rejection block. Or from a 4-hour rejection block, it can be a daily old high, the opposite. You understand? So study this thing, because I cannot put up every single idea into this one single video, but you have to do your own due diligence and make sure you study it really attentively and take notes. All right, let's move on. Now, summary of the PD array matrix. We have mitigation block in it, rejection block, bearish and bullish order block, breaker block also bearish and bullish, and the rejection block. Correct? All these are order blocks. Know this, all these are order blocks, some type of an order block. Next we have what? The gaps, fair value gaps, liquidity voids, volume imbalances, and opening gaps. This can be daily, monthly open, weekly open, new week open, new day open, whatever. These are the internal range liquidity. Okay, all of this are internal range liquidity, because these happens on the internal side of the price action. The other hand, we have all highs and all lows in the PD array matrix, right, which are the external range liquidity. Summarize it properly, like just relate one thing to other. There are different names for the same thing. All right, so just keep it really simple, do not complicate it. External range, why? Because all highs and all lows are at the external edge of the price action. Correct? Now, this is the normal depiction of what happens. Price delivers from internal range, meaning IRL to ERL, or from the ERL to IRL. Look for the candle ranges. We are trading CRT, right? So we have to look for the candle ranges at the edges, or at the external range or the internal range of liquidities, right? This is an FVG. This is a price move right there. This is an FVG. If price delivers, price is bullish, okay, it delivers from a high to an FVG over here in a discount, okay. This is an internal range liquidity. Once the internal range is touched and you see your model form in this along with time frame alignment, you go long targeting the opposing end, which is the external range liquidity, or the 50% of this whole price leg, the 50% of this price leg. All right, move up, price goes up, comes back down, takes out this liquidity. This becomes the external range. This low becomes the external range. Price takes it and then goes back in to an internal range and then delivers back down. Sorry. For example, if price is at a daily bullish FVG, this can be a daily FVG, look for a 1 hour candle range to form inside that FVG. You'll see, you look for your CRT candle to form at the right times into this zone right there, right? Why? Because this is internal and price delivers from internal towards external, correct? I don't know if I'm going too fast or too slow. I don't know that, because it's just impromptu. But if you're not understanding it, I urge you to rewind it and watch it again. All right. This was just one example. This can be a weekly FVG, and you look for a 4-hour CRT. This can be a 4-hour FVG. You can look for a 15-minute CRT or a 5-minute CRT. Sorry, the entry. All right. 4-hour FVG, 15-minute CRT, and 5-minute or 1-minute entry. Great. Now let's move on. Liquidity. Oh, the same concept again. What the hell is liquidity, and why are you teaching us this again and again? Why? Because repetition teaches, right? Time-based liquidity are what? Previous month high, previous month low. You should remember my previous videos. I have mentioned that if you are on a monthly level, you should just look for the previous month's high and previous month's low. If the low is taken, look for the high. If the high is taken, look for the low. Same goes for the previous week's high and previous week's low, previous day's high and previous day low, previous sessions high and low. Why? Because a lot of stop losses are at the highs and at the lows. Simple. Really simple. A lot of stop losses are at the highs of all these time-based zones. A whole month is a time period, correct? A whole week is a time period. A whole day is a time period. Whole session is a time period. That's why. Now, something interesting for you to see. The highs and lows of the above mentioned zones are the time-based liquidity. If you know what this is, time-based liquidity, the high, just this, the high and the low, the high and the low, the high and the low. This is the time-based liquidity. What is happening inside of it is price action. I'll give you an example. Right there. This is the time-based liquidity. This is the high. You don't know. This is fixed, predetermined already. The highs and lows are predetermined and fixed in time. Okay. This is fixed in time and this is fixed in time. This one, for me, it's already predetermined. People say that the open and the close are predetermined and fixed, of course, because that's also time-based. This right here, the movement inside of it, is what we call price. Whatever happens inside the two time points, one time point and the second time point, is price. And why are we taking this one? Because it's already happened. Price, previous week high and previous week low, because we don't know when the high will form, right? We don't know yet. But that's why we use history as our precursor or our barometer, whatever you want to call it, right? This moment inside, price moves from one point in time to another point in time. Price moves from one point in time to another point in time, and then from another point in time to another point in time in the low, right? Whatever happens inside here, this moment has accumulation, manipulation, distribution, reversal. Everything which you see, everything is over here. What's happening? Understand this. This is really basic, but extremely complicated for us to understand. Whatever is happening in price is between these two time points. This can be a monthly high, this can be a monthly low, this can be a sessions high, this can be a sessions low. Time and price, they're fractal in nature. So whatever you see on the lower time frame happens on the higher time frame. Whatever happens on the higher time frame happens on the lower time frame. Understood? So another one actually I would like to let you know is what happens inside the two time points. What's happening inside? Everything, every single thing between these two time frames, these two time zones, boils back down to the power of 3. This is a major ICT concept, and I'm not making several videos about it. Why? Because I'm not trying to sell anything at all. It's just you need to make sure that you understand this. You personally, you are your own competition, no one else. I'm not your competition, the market is not your competition, you are your own competition. So if you play around and just take it casually without realizing that the importance of this thing, you're potentially gambling. All right. So what happens inside two time zones, two time periods and two time points? Let's suppose this is a previous week high and the previous week low. The next week it will open. If it's bullish, it will open, accumulate, manipulate at a specific time or day, and then distribute at a specific time or day, or reverse as well. All right. There can be a reversal after this one, this price leg. But This thing is always present in price, always. Power of 3 is always present. Why? Because smart money, institutional money, whatever you want to call it, Godfather, whoever, they accumulate the algorithm, it accumulates the orders, you know, generating liquidity back and forth, takes out one side of the liquidity, right? Makes people think that it's falling again, makes them sell short over here at the breaking point, and then takes the price back up, right? You should understand the delivery algorithm perfectly once you go deeper into the ICT videos. This one, power of 3, is always present from top to bottom, from bottom to top. How? I'll let you know right now. How to use the power of 3? People say, yeah, everything is power of 3, this and that, but then how do you use it? What actually happens? Is it like some magic trick? It's like, is the market going to let you know that it's in an accumulation zone? It's going to manipulate at this time and it's going to distribute? Is it going to tell you? No. But what do we have? We have history of data. We have previous price actions, which proves that this particular scenario is always going to work. Right here is an example. Price approaches a key level, then price does not actually take out the key level. Price starts to accumulate over here, right? High, low, and then this is the range bound. Again, high, does not break above, range bound, and then finally at the specific time price takes out the high. And then this is the manipulation, the second phase of the power of 3, and then we see distribution at a really rapid pace. How? Example, this can be a 4-hour key level, FVG, internal range liquidity, M5 power of 3, 5-minute time frame, 5-minute time frame range, 5-minute time frame high, taken, manipulation, 5-minute time frame distribution. Now we use standard deviations from the manipulation leg, from high and low, to form our targets. Your target can be over here, this one, or your target can be whatever the next level is, or the standard deviation. I'll let you know in the next few slides how to use that. Here is another example of the power of 3 and how is it present. See, this is literally the example of power of 3. Okay, this is it. Whatever is happening, this is it. It's happening always. Look, accumulation, manipulation, distribution. All this is the distribution. Tiny little accumulation here, manipulation, distribution. Accumulation here, you can see, manipulation, distribution. Accumulation, manipulation, distribution. This is a zoomed in kind of image of this one. Accumulation, manipulation, distribution. Over here as well, look, accumulation, manipulation, and then distribution. Another one. I sound like DJ Khalid again. Here, accumulation, manipulation, and distribution. Of course, given the fact that you know your order flow. Okay, that's another topic actually. And here it is. Sorry, the PDRA matrix. Okay, there were order blocks and FVGs, meaning the internal range liquidity and external range liquidity, right? Order blocks, of course, they become internal range key levels because they happen inside of the price action. This is some random ass order block. Price comes, forms an order block, change in the state of delivery right here, fake ass market structure shift. Dumb money starts to buy, thinking that yeah, this pattern holds, and then you can see the results. This is some random order block. This is a time based order block. The difference, this is an ICT concept, this is also an ICT concept, but you only see this concept in his video. This one you have to find out for yourself. Over here I'm presenting it for free because it took a lot of time and a lot of effort for me to understand these things. Order block, time based order block. This can be a 3 a.m., 9 a.m., 2 p.m., 3 p.m. order block, anything particularly. There can be always be a key level over here, and then this order block holds, as you can see. Another example, FVG is an ICT concept. Time based FVG is also introduced to us, but this one To learn this one, it takes time, but over here in this video, you're looking at it. Some random ass FVG, it does not hold. FVG formed at some specific time holds. Order block at the specific time holds, right? So if you're looking at your key levels, all right, if you're on a 1 hour time frame and you're looking at the key level, like suppose this is in a 1 hour time frame, okay, you're looking at this key level and you want to be bullish, okay, price moves up, comes back down into the FVG. How do you know this FVG will hold? Time. How do you know this FVG will not hold? Time. This can be a, I don't know, 5 p.m. FVG or 1:30 lunch hour FVG, 12 to 1:30 FVG. It does not hold. Why? Because there is a lot of liquidity in the previous session. That's it. This FVG, since this session has begun, suppose it's a 9 a.m. candle, okay, this is a 9 a.m. FVG. We all know that the market, when the equities open, we take a lot of liquidity already, which was present in the previous sessions. So if it's taken, this FVG along with time is high probability, and you can see the result. All right, so ICT concepts, just don't go blindly behind it. Try to learn the concepts through time. I always want to make sure and press the fact that time is more important than price. You have to pay attention to time, quarterly theory, EBITDA data ranges and everything. This is just the summary of what would be better for your understanding of CRT. Now over here we have a key level, okay, price manipulates right there, distributes higher. This is what I was talking about, the standard deviation 1, standard deviation 2 and 2.5. This is one of the ICT's favorite entry, the unicorn model. Okay, this is something which has been moving a lot in the YouTube realm. What is it actually? Price reaches a key level, price creates a range right here, manipulated lower, breaks higher and leaves an FVG, broken higher over here and left an FVG right there. Use the fib tool to measure the targets from the low to the high. Okay, if you're bullish, you put the fib from the low to the high of the manipulation leg. This high was the one which started the manipulation lower right there. So this right here, if you break above a high after taking the liquidity and then you leave an FVG with a breaker block, this is a unicorn model, and this delivers one of the fastest delivering algorithms present. Okay, so if you're really afraid, like you're really not that much advanced and you do not want to take the entry over here at the turtle soup, you can always wait for another confirmation, which is price breaks above at key level at key times, comes back to the breaker, and you put your limit at the breaker or market execute, and then your stop loss can be below the breaker or below the low. I would suggest to keep the stop loss below the low, because if that's the true liquidity sweep, it will not be touched. Okay, usually the price delivers to the second standard deviation. So over here, if your entry is over here and your stop loss is right below the low, this is 1:1 right there. Okay, here 1:1, here 1:2. 2 RR entry is fixed, usually like 80%, 85% it's fixed in the unicorn model along with CRT. All right, I'm mentioning this because some people are really not that much advanced and they cannot even take the order block entry, right? They want to wait for more confirmation. So the unicorn model is the best confirmation for you. Okay, so this is the standard deviation fib setting: 0, -1, -2, 2.5, -3, -4 and 1. And these are the color settings. I just use this, I don't clog the chart too much. In a nutshell, what did I just teach you guys? You have a drawn liquidity, which is the buy side liquidity. You have a key level. You have your price driven down from the open. This is the open. This is the Q3, meaning the quarterly theory, which you would know I have taught in my previous videos as well. Basic ICT concept, guys, basic ones. Just make sure you understand it and do not complicate it. Just follow these things only. it's better for you, it's enough. And this is the OTE entry right there. Q3, price breaks above the highs over here, breaks the high, you know, you have the change in the state of delivery and everything. Price delivers back down. This is the kiss of death. Why? OTE 0.71, 0.79. This is the setting. These are the levels. Okay, go to your fib, open up the chart, like, you know, unmark everything like this, unmark all of it, just then start marking 0, 0.71, 0.79 and 1. This is your OTE. These levels are your golden zones right there. This is a sniper entry. If your bias and your analysis is correct, this would deliver the quickest, you know, it's a violent move towards the drawn liquidity. Once again, price delivers. Same thing which happened over here. Kiss of death, range, manipulation, higher. Range, manipulate below, distribute higher. Range over here, this is also a range. This is not a price delivering below. This is a range. High, low, and it's stuck in between. All right, range, low, distribution. Understood? Again, range, price takes out low, turtle swooping these two lows, distributes higher. Price starts to range from here again, turtle swoops all these lows, all right, and then moves higher towards the liquidity. Have this one, right, having the idea where price wants to go, right, is it's gonna, like, you know, get done. Your 50% of your task is done already if you know where price is going. If you do not know, just wait for any particular, you know, drawn liquidity to form. This can be anything. This can be a previous session's high, week high, day high, whatever. Always look at the highs. Okay, so these are the concepts which you want to integrate with CRT. Integrate it with CRT. Do not just blindly trade all these things, because CRT for me is the highest level of you know, technical analysis, for me at least. I can be wrong, and someone else might have another idea, which is welcome, more than welcome, of course, and I'm not to judge, but this thing is for me. This thing works along with IBDA data ranges, quarterly theory, and you know, proper entry models and psychology, of course. On psychology, I'm going to touch in the next coming videos, and next video I'm going to be making sure that I deliver quickly to you guys, okay, and I do not delay myself. So thank you for watching. If you're not subscribed to the channel, I urge you to subscribe it, and I'll see you in my next video. Good luck and good trading.